dividend payment options and premium offset for participating policies can be found in section 3.4 and 3.7 in your study notes if you are looking for additional information. The dividend payment options are cash accumulation, term insurance, premium reduction, and paid up additions. So we're going to go through these 5 different options over the next couple slides. As I mentioned, there are 5 options. It is set in the contract what those options are going to be. And the first 3 conveniently spell CAT, so that should help you remember them. Cash accumulation and term. And then the following 2 are a double P, premium reduction, paid up additions. And so a couple of things before we dive into actually what each of these are about. Really important to remember that the dividend scales are not guaranteed. Remind your clients that they can change and they will change. The insurance company will issue what the new dividend scale is to the clients, and there probably will be some sort of alteration. Now, when you're selling par or explaining par, you use illustrations to show how the dividend can grow and how to compare each option. However, it's important to remember that these illustrations, the scale doesn't change. It is set in those illustrations, and that is actually not the reality of par policies. So definitely take some extra illustrations that show what will happen if the dividend scale drops or if it increases, so that your clients really get a full grasp of how the dividend scale can change and how it can affect the growth within their dividends. The first is cash, and it's super, super easy to understand. Your dividend is issued in a check and mailed or electronically transferred to the client. Whatever the total amount of the dividend is what the client receives. The second is similar to cash accumulation. That dividend is put into an account, and with that account, the dividend can either be saved, invested, used in addition to the death benefit, so paid out with that death benefit. It can also just be withdrawn by the holder. So what happens in that accumulation fund is really up to the client. They have a lot of options there, and they can just use that money if they need it. The last one on this slide, term insurance. So the coverage for term insurance is just 1 year. And what happens is the dividend is issued, and that dividend is used to purchase the maximum amount of insurance that dividend will cover. So let's say the dividend is $100 for the year. The insurance company will purchase a policy that is valued at $100, and the death benefit will be the maximum amount they can get for $100. Now remember, this is only a 1-year term. So after 1 year, the policy does expire. The next 2 are the 2 Ps, which are premium reduction and paid up additions. So premium reduction is great. It actually helps the client save some money. The dividend that is issued, so that same $100 we were talking about earlier, it's applied to the premium. And so if their premium is $120, they're only paying the difference. So they are just paying that $20 there. And that really can save clients money. And over time, it's possible that that dividend can grow to cover the entire premium. So instead of $100, maybe it's hitting $120. And so in that situation, the policy actually goes into premium offset. Now, with premium reduction, it is possible that it can come out of premium offset. But during the time that the holder, the payer, is not paying for the policy, it is in premium offset. The other option is paid up additions. And now paid up additions are a little bit complicated, or PUAs, but they are a really great dividend payment option. And so it's really important that you understand and are able to explain this to your client. So similarly to term insurance, the dividend is taken and used to purchase more insurance. Now, the difference is that the insurance that is being purchased is a replication of whatever the original policy is. So the original policy in this case is a par policy that has a cash value and has dividends. And the same thing is happening with the paid up addition that is purchased. Now, the insurance that is purchased, the death benefit, is the maximum amount that the dividend will allow to be purchased. So if that $100 purchases $30 of paid up additions, then that's how much is being purchased. And so that, like I said, has a cash surrender value and paid up additions as well. And this is fully paid up. So that means that no more premiums are owing. It will not expire. It will not end after 1 year. And the cash value in that PUA will actually grow over time and increase the value of the policy. Now, that cash surrender value can actually be used to offset premiums if the policy is canceled. So what happens is with the paid up additions, the client can surrender the paid up additions and take the cash surrender value and apply it to the policy or the original policy that they had in force and pay for the future premiums. That is a possibility. But this does require the holder to surrender the PUA. So that is something that's really important to understand. And it might be possible that it's better for them to actually keep it in force. Remember, the PUAs are increasing the death benefit, increasing the cash value, and increasing the additional PUAs that can be purchased. So it kind of ends up as this continuous cycle that your policy is continually growing as you might have more insurance. So it is a really good option on the dividend as one of the dividend payment options. So both of these dividend payment options can lead to premium offset. They are not actually necessarily dividend options with the paid up additions, but it can be used for premium offsets. So that's something that's great to remember. And that is all we're going to go through with the dividend payment options and the offset, premium offset. If you're looking for more information, please do check out your study notes, 3.4, 3.7,